For decades, it felt like the world's biggest economies were all reading from the same script when it came to trade. But now, it seems like that script is being completely torn up. A fundamental economic tool, one that a lot of people thought was a relic of the past, is suddenly back at the very center of global policy. And that tool is the tariff. Yeah, for most of the last 70 years or so, really since the end of World War II, the global economy looked like it was on this one-way street. A street headed directly toward free and open trade. The core belief was really simple. The fewer barriers you have, the more growth you get, more innovation, more prosperity for everyone. But that long era of open trade, well, it really seems to be fracturing now. A totally new chapter in global economics is being written, and it's challenging the very foundations of that entire post-war system. Okay, so before we go any further, let's get on the same page about the central term here, the tariff. What is it exactly? Well, a tariff is basically just a tax. It's a tax on goods and services that are imported from another country. Governments use it as a tool to make foreign products more expensive, and the goal is usually to protect their own domestic industries from that outside competition. All right, so if tariffs just make things more expensive for everyone, you might be wondering, why on earth are we seeing them make such a huge comeback? And that question gets us right to the rationale behind this whole new wave of protectionism. What are the arguments being made for such a dramatic shift in policy? So, if you look at the official, stated goals, there are basically four big ones. First, the idea is to promote and revive domestic manufacturing. Second, it's about protecting national security, by being less reliant on foreign supply chains. Third is the goal of correcting trade deficits, which are seen as a big problem. And then there's a fourth, kind of more radical idea, using all that tariff money to actually substitute for federal income taxes. And this right here, this really gets us to the heart of the debate. The policy is built on this core belief that trade deficits, that's when a country buys more than it sells, are just inherently bad, a sign of economic weakness. But, and this is a huge but, most economists completely disagree. They argue that a trade deficit isn't some kind of loss. It's really just a reflection of these complex global money flows where foreign investment coming into the US actually balances the whole thing out. Okay, so that's the rationale. With that in mind, let's take a look at what this new trade strategy actually looks like on paper. How do these big ideas translate into actual specific numbers? Well, the centerpiece proposal is a new baseline tariff of 10%. And that's not on some things, that's on pretty much all goods imported into the country. This would be a massive departure from the near zero rates that we've all gotten used to for a lot of products. But the policy is also really targeted. When it comes to goods coming from China, the proposed rate isn't 10%. No, it's a staggering 60%. I mean, that's just a massive escalation in the trade conflict between the two biggest economies in the world. And we're not just talking about adding new tariffs here. Existing ones are getting ramped up too. For really crucial industrial imports like steel and aluminum, the rate would literally double, jumping from an already high 25% all the way up to 50%. So this table kind of puts it all together for you so you can see the full scope of what's being proposed. You've got that universal 10% tariff, and then right alongside it, you see the much higher targeted rates for China, for steel, for automobiles, and even for copper. And pay attention to that column on the right, the legal basis. You see things like IEPA and Section 232. We're definitely going to circle back to what those mean in just a little bit. All right, so that's the plan on paper. But what actually happens when these kinds of policies are put into practice? Let's dig into the ripple effects because they're felt both here at home and all around the globe. Well, one of the first and most immediate impacts you see is retaliation. Other countries don't just sit back, they hit back. And for the U.S. agricultural sector, the blowback has been absolutely immense. Just look at this number. A staggering 94% of the export losses farmers faced from these retaliatory tariffs came from just one market, China. And it's so important to remember that these aren't just abstract numbers. They represent real people, real livelihoods. Caleb Ragland, the president of the American Soybean Association, he put it perfectly. He said, market relief is great, but the reality is that it's a Band-Aid on an open wound. What we need is trade. And it wasn't just agriculture getting hit either. For example, when the European Union retaliated against U.S. steel tariffs, they didn't hit back on steel. They targeted iconic American products, like whiskey.
And that prompted these industry groups to form coalitions with names like Toast Not Tariffs to protest these policies that they said were really hurting their businesses.
And I mean, this chart tells the whole story in just 3 bars. It's like a 3-act play. Before the tariffs, American whiskey exports to the EU were at $552 million. Then, during the tariff period, look at that drop, down to $440 million. But the moment those tariffs were suspended, boom, exports shot right back up and were even projected to go higher than before. You can't get a clearer picture of the direct impact than that. All this unpredictability, it also really rattled the financial markets. After just one of these big tariff announcements, the S&P 500 fell almost 5%, and the Nasdaq dropped nearly 6%. Just poof. Billions of dollars in market value gone. It was a clear signal that investors were really, really worried about a full-blown trade war. And ultimately, of course, these costs don't just stay on Wall Street or in corporate boardrooms. They trickle down. According to an analysis from the Yale Budget Lab, the total cost of these tariffs for an average U.S. household could be as high as $2,400 a year. That's because companies just pass those higher costs for imported goods straight on to us, the consumers. Okay, so all of this, the economic theory, the real-world impacts, it brings us to our final section, the fundamental legal and even constitutional questions that are right at the heart of this entire policy shift. And it all boils down to one critical constitutional question. Can a president impose such sweeping tariffs all by themselves, or is that a power that belongs to Congress? This is really all about the separation of powers. If you look at the Constitution, it's pretty clear. It gives Congress the sole power to levy taxes and tariffs. But over the decades, Congress has passed laws. You might have heard of the Trade Expansion Act, or IEPA, that have delegated some of that authority to the president. The key word there is some. It's usually only for very specific reasons, like a national security emergency. So you have this fundamental conflict between presidential action and congressional authority, and that has led, maybe inevitably, straight to the courts. And as you can see from this timeline, the legal challenges have moved really fast. Lower courts ruled that the administration went too far, that it exceeded its authority. That decision was then upheld by an appeals court, and now the whole thing has culminated in a major showdown at the Supreme Court. But, this legal battle is really just one part of a much, much larger question, a question that's going to define the next era of global commerce. As these old rules of trade are being completely rewritten, pretty much every country is now facing the exact same challenge. What's the right balance? The right balance between protecting your own national interests and preserving the kind of economic interconnectedness that has really shaped our world for generations.